Markets are continuing to price in an interest rate cut in December. That's despite Federal Reserve Chair Jerome Powell's recent hawkish comments, saying another cut this year is not a foregone conclusion. And it's not just rate cuts that have all eyes on the Fed this year. Investors are also waiting to see who will become the next Fed chair and what the future of Fed independence will look like due to ongoing pressure from President Trump. Joining me now at Invest is Lael Brainard, former Federal Reserve Vice Chair, former Undersecretary of the U.S. Department of Treasury, and former Director of the National Economic Council under President Joe Biden. Lael, always a treat to get some time with you. I thank you for coming to Invest. The debate right now in markets, the day after the government shutdown has officially ended, is the lack of data. And the Trump administration has locked in on the fact that we may not get this data from the past few months. How concerned are you about the lack of economic data that's likely to come out?
Well, it is a very unusual juncture. Going into the December meeting, it's just much less clear where the Fed is going to go than it was back in September. And it's not primarily because of the lack of data, although the lack of data just makes it worse. It is because we have heard from both sides of the Monetary Policy Committee that both the hawks and the doves are digging in, with the hawks saying that inflation is 3%. It has been for 44 months now. And it is projected to remain in that territory because of the tariffs. On the other side, the doves are saying that the labor market appears to have softened given the last public sector data that they have, as well as some private sector data. And both sides are right.
Before the government shutdown, Lael, there was a general consensus that the economy was slowing down, as seen through the prism of U.S. labor market data. Why was that happening?
So I think we have a very clear two-track economy. We have the AI sector, and all of the related sectors are seeing record interest in the stock market, are seeing massive investments, data centers, electricity, chips. The leading sector is doing extremely well, but it's not hiring. And the rest of the economy is suffering. It's suffering because it is less favored in the capital markets. It's suffering because it is still trying to digest those tariffs. And then it's also, a lot of those businesses are not clear how much should they hire given what they're hearing about integrating AI into their businesses. So for all those reasons, neither the booming sector nor the remainder of the economy are really hiring. And meanwhile, you have very divergent economies.
Is the economy in a recession?
I would say you saw the second quarter growth number coming in very strong, 3.8%. Consumers remain resilient. Now, we know that that is the top of the consumer income distribution, but they do remain resilient, driving spending. And all the estimates are that third quarter GDP is going to come in quite similar. So the economy at the top level is strong, but again, it's being driven by this really important set of investments in AI. The rest of the economy under the hood is really stuck.
You bring up a good point, Lael. Why do you think the wealth we're seeing built at the top end, as seen through the prism, of course, of the stock market, why isn't that trickling down to the average household?
So you saw it in the election. Clearly, people in the lower half, even the lower 3/4 of the income distribution, are really concerned about affordability. They've seen prices of coffee and bananas going up, housing costs not coming down, utilities costs going up. So they're very worried about that, and they're worried that their job opportunities are not as good as they were a year or 2 years ago. You see that in the consumer sentiment surveys, whereas that top 10% of consumers, their housing values have gone up, and of course their stock portfolios are very positive.
I'm glad you mentioned coffee and bananas, Lael, because the Treasury Secretary, Scott Bessent, is out this week saying the administration plans to put policies in place to bring prices down for coffee and bananas. Maybe this is the new egg debate. Whatever the case is, you're in government. Can the administration actually do this? Can they bring these prices down for these two key ingredients?
So, look, I think it is interesting, first of all, to see the Secretary of the Treasury and the administration wake up to the fact that people are really unhappy about prices and affordability. Don't forget, just a few months ago when they were putting tariffs in place, he was talking about how, well, there'll just be fewer toys under the Christmas tree come Christmas time. Now, I think they're seeing that actually consumers are really troubled by this affordability. And to some degree, they can take tariffs off where they've put them on. And that is what they're talking about. But it will be very difficult for them to fundamentally reverse the affordability crisis in areas like housing and, of course, in healthcare because of some of the expiration of the tax credits. It's actually going to get worse for millions of families.
Do you believe the higher prices we have seen, coffee, bananas, whatever it is, furniture, apparel, are tariffs causing this inflation? And then do you think the administration will come to regret these tariffs?
So, look, I think in areas like baby clothes and strollers and toys, furniture, those are clearly tariff related. You can see the tariff lines. Coffee, bananas are hurt by tariffs, but in some cases there are structural forces that are making these worse. And so, for instance, the demand for electricity is growing at a rate we haven't seen in many years because of the boom in AI, and that is inevitably going to put pressure on consumer electricity prices. And that is something that is more complicated and difficult for the administration to reverse. Of course, it didn't help that they got rid of a lot of the alternative energy incentives. They have brought prices down. We're seeing lower prices at the pump by a little bit. But some of these other forces are going to be difficult for them to reverse without reversing their own policies.
I talked to a noted economist, Lael, Mohamed Al-Arian, earlier on at our Invest event. He said this, quote, "I believe that this Fed went to sleep." And Mohamed was referencing that the pressure, like you were mentioning too, on lower income consumers. Is the reality that the Fed, that meeting, December 10th, decision day, they need to come out here and cut rates and make it clear that more rate cuts might be needed to ease the pressure on households?
Well, I think they are in a difficult spot because they have the most powerful inflation fighting tool. And of course, with inflation now not continuing to come down, but stalling out around 3%, a little higher, they are concerned about inflation. I think most members of the committee believe that this is a transitory impact. They don't like to use that word, but they do expect the tariff effects to dissipate, so no further increases from tariffs eventually. And the other side of the committee, I think, has been sounding the alarm about the weakening labor market. And that was what we saw in September, a very clear commitment to cut 3 times in those projections. But it turns out that 9 of the 19 members were not actually on board for 3 cuts. And so that is what we're going to see play out in December. Even if we see a cut in December, it's likely we would see a pause after that, given where the hawks are on the committee.
If you were still in the Fed, Lael, would you argue for a rate cut?
I would. I would be concerned about the weakening labor market. And I think I would take the risk that perhaps tariffs push prices higher for a little longer against the risk that we really see a self-reinforcing downturn in the business sector that leads to real pain for American households. So weighing those 2 risks, I think as many members of the committee, including the chair, has articulated, they are more concerned about the risk to the downside on the labor market. We just heard that again from Governor Cook. And they're willing to take a little bit more risk on the inflation side of the mandate.
That decision on rates, Lael, is just, of course, one day on the calendar. You look out through this whole year, and it comes against a backdrop of really unprecedented attacks on the Federal Reserve by President Trump and various members of his administration. Are you concerned that these attacks have undermined the credibility of the Fed longer term?
I am very concerned. I think everybody should be concerned because, of course, the Federal Reserve's independence is what is key to its credibility on inflation fighting. And the fact that most people believe that they will bring inflation back down to 2%, that inflation expectations are well anchored, is rooted in that independence of the Federal Reserve. So we've seen, as you said, unprecedented moves to fire a board member without cause. We have seen another new board member appointed while remaining on the staff of the president's office, and ongoing statements from the administration that they believe that the Federal Reserve needs to lower rates in part to bring debt service on the national debt down, which of course is a real violation of Federal Reserve independence if it were to happen. So for all those reasons, I think investors and the public should be carefully watching what happens over the next few months in terms of the Supreme Court case on the firing of the governor without cause, as well as the appointment of a new chair and what that signals.
Of course, the list to replace Chair Powell next year down to 5. Are you confident in these 5 choices?
So the lists that people have talked about publicly, they are all highly qualified individuals. And the real question is the extent to which each of them can truly be independent of the White House and be perceived to be independent, because at the end of the day, it is that public perception that the Fed truly is independent and makes its own calls based on its dual mandate, which is to keep inflation low, keep the economy at full employment. That is what anchors inflation expectations, and it makes it easier to bring inflation to the 2% target without causing unemployment to rise.
Well, before I let you go, Chair Powell, he's been a constant in markets for years now. What do you think his legacy will be?
Well, I do believe that the single most important legacy will be his very determined efforts to guard the independence of the Federal Reserve, to make sure that the Federal Reserve maintains its institutional strength and resilience. And of course, that is the most important legacy he can hand to future Federal Reserve chairs. It's also the most important legacy to serve the American public, because it means that they can have confidence in low inflation and that it won't require high unemployment to bring inflation down.